What if someone handed you a mathematical blueprint, precise entry levels, an exact ceiling, and a countdown timer on a short squeeze, and every single number played out like clockwork? That is not a hypothetical. That is exactly what happened with Nebius Group, ticker NBIS, over the last 5 trading days. And right now, after a landmark Nvidia deal sent this stock exploding and Wall Street scrambling to revise their price targets into the triple digits, Smart Stock Sam is here to tell you that the move you just witnessed was only the opening act. Today, we are breaking down the Nvidia partnership that just restructured the cost foundation of this company forever, the $20 billion revenue backlog that sets an iron floor on valuation, and the precise technical roadmap that tells you exactly where this stock is heading next. Stay locked in, because by the end of this video, you will understand why missing the next leg of this trade would be the most expensive decision you make all year. Let us go back to March 5th, because that is where this story begins. Smart Stock. Sam laid out a technical roadmap that a lot of people called far too optimistic. We identified a very specific accumulation zone, what we called the gift zone, sitting between $88 and $91.50. Now here is where it gets interesting. On March 6th, the stock closed at $89.33, dead center inside that gift zone. We then called a support bounce at $87.35. The market bottomed at $86.50 on March 9th before aggressive institutional buying stepped in hard, and the precision ceiling we set at $108.32. On March 11th, NBIS did not just reach that level, it smashed clean through it, hitting a high of $114.08. When a technical blueprint hits 4 out of 4 data points with that level of accuracy, that is not luck. That is the anatomy of a perfect technical breakout unfolding in real time. Now here is the question nobody is asking. What if a breakout of this magnitude was actually the smallest move this stock is capable of making? Because a rally this violent does not happen in a vacuum. Something fundamental has to change. And on March 10th, something absolutely did. The stock reclaimed its 50-day moving average, and the bears were officially trapped. By the time we opened on March 11th, the fuse was already lit. A gap up to $105.14 left every single person waiting on the sidelines completely behind. But the real catalyst, the one that changes everything, that is what we need to talk about right now. Nvidia did not just sign a partnership deal with Nebius. They made a $2 billion strategic investment to acquire 21 million Class A shares. $2 billion from the most powerful company in the semiconductor world. But here is the piece that the mainstream financial media keeps glossing over, and this is the part that actually matters most for long-term investors, the structural moat. Because of this partnership, Nebius is reportedly receiving a $20,000 per unit discount on high-end GPUs. Think about what that means when you are building AI factories at gigawatt scale. A $20,000 cost advantage per chip is not just a nice perk. It is an unbreachable competitive wall that every single competitor in this space simply cannot climb over. This is no longer a growth story. This is a structural dominance play dressed up as a momentum trade. And what is the one thing even more powerful than a cost advantage? The answer is locked-in revenue. Nebius is currently sitting on $20 billion in secured contracts. $20 billion. To put that number into perspective, they hold a $19.4 billion AI computing contract with Microsoft and an additional $3 billion contract with Meta. What does that mean for you as an investor? It means the revenue floor of this company is not speculative. It is contractually guaranteed. In a market defined by volatility and uncertainty, knowing that billions of dollars in revenue is already inked and scheduled for delivery over the coming years completely reframes the risk profile. The current price starts to look less like a momentum play and more like a generational value opportunity. But here is what should terrify the bears even more. Institutions are not just watching this play, they are actively locking up the float. As of today, 50.04% of the long float is held by institutional investors. BlackRock alone has built an $800 million position. We are seeing fresh filings from EMC Capital and SHP Wealth Management. Susquehanna, Citadel, Morgan Stanley, they are all sitting on the same side of the table, when the biggest allocators of capital on the planet are consolidating half the available float. What do you think happens to the price when retail demand starts to accelerate? Could the float get so locked up that even a modest increase in buying pressure triggers a move that makes this week look small? They have the chips, they have the cash, they have the contracts, and now they are building the factories to match. Nebius just secured approval for what will be the largest AI factory in the United States, located in Independence, Missouri, with a 1.2 gigawatt capacity. And the long-term global roadmap calls for over 5 gigawatts of deployed infrastructure by 2030. That is not incremental expansion. That is civilization-scale build-out designed to meet the compounding demand from hyperscalers who are genuinely desperate for compute. And to drive that global rollout, Nebius has been pulling top-tier talent away from the biggest names in tech. Dan Lawrence, formerly of AWS and Akamai, is overseeing U.S. commercial scaling. John Harrer is leading the Asia-Pacific charge across Singapore, South Korea, and India. This is a dream team of cloud and AI veterans who have built multi-billion-dollar enterprises before. Now here is where any rational investor has to pump the brakes and ask the hard question. After a 16% intraday gain, with volume surging from 13 million shares to 19 million shares, is this stock getting too hot to touch? The honest answer is, right now, yes. The 14-day RSI has hit 78.14. Anything above 70 is technically overbought territory. Does that mean the rally is over? Absolutely not. But it does mean a short-term consolidation or cooling off period is highly probable before the next major leg up. Do not chase the green candles when the RSI is stretched this thin. The smart move here is patience. Because here is what patience actually buys you, the setup for the real explosive move. Currently, 20.70% of the float is shorted, nearly 44 million shares that must be bought back at some point. With a days-to-cover ratio of 5.39, the short sellers are sitting in an extraordinarily dangerous position. If this stock continues climbing toward those analyst targets, those bears do not get to wait and see how the story ends. They will be forced to cover their positions, creating a secondary squeeze that could send NBIS vertical in a matter of days. Could we be looking at a short squeeze that makes even this week's breakout look like a warm-up? The options market is already pricing in exactly that scenario. Call volume is currently running at 4 times the daily average. We are seeing massive clustering at the $110 and $115 strike prices for the March 13th expiry. These levels are acting like upside magnets, pulling price toward them with the gravitational force of institutional conviction. Wall Street is waking up. Northland Securities has a top pick price target of $232, representing over 100% upside from current levels. The immediate resistance sits at $114.31, with a consensus zone climbing toward $147.45. So what is the actual execution plan? Simple. Do not chase here. Wait for a buy the dip opportunity in the $104.80 to $106.50 range. This allows the overbought RSI to reset to a healthier level. Hard support tiers sit at $102.87 and $98.75. Your stop loss, the level where you accept that the parabolic trend is invalidated and you reassess entirely, is a clean breach below $93.70. Respect that level. Trade the pullbacks, not the spikes. Before we wrap up, a quick but important reminder. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes financial advice. Always conduct your own research and consult with a licensed financial professional before making any investment decisions. Markets involve risk, and past performance of any technical setup does not guarantee future results. So, Here is the bottom line on Nebius Group. The Nvidia $2 billion investment has set a structural cost floor that competitors cannot replicate. A $20 billion secured backlog provides contractual revenue certainty that most growth stocks can only dream about, and 20.70% short interest is a coiled spring waiting for a trigger. This is the AI infrastructure trade of 2026. The status is strong buy. The strategy is simple. Execute on the pullback, respect the stop, and target those 140-plus consensus zones with your eyes on the $232 ceiling. Now I want to hear from you. What is the one fundamental metric you believe matters most when evaluating an AI infrastructure stock? The backlog, the institutional ownership, or the short squeeze setup? Drop your answer in the comments below. If this breakdown helped you think differently about this trade, hit that like button. It genuinely helps more investors find this analysis. And if you are not subscribed to Smart Stock Sam yet, now is the time. The next setup is already being built. Do not miss it.